Hello everyone! As a wealth management advisor focused on serving new immigrant families and US-based professionals, I often help clients evaluate year-end financial considerations that must typically be completed by December 31st. These actions may help improve tax efficiency, strengthen retirement readiness, and support overall financial planning decisions. Today I've prepared for the 7 key year-end moves with the latest 2025 limits and rules to help you in optimizing tax efficiency, strengthening retirement account growth, and improving families' overall financial security. Let's dive straight into the practical strategies. 1. Year-end tax loss harvesting, using investment losses to offset gains. Tax loss harvesting refers to selling investments at a loss to offset taxable capital gains. A loss may also offset up to $3,000 of ordinary income annually, subject to IRS rules. Example: you made $12,000 in investment gains this year, but one tech stock is down $5,000. If you sell that losing stock before year-end, your taxable gain for the year becomes $12,000. $5,000 equals $7,000, immediately lowering your tax bill. Be mindful of the wash sale rule. If you repurchase the same or a substantially identical security within 30 days before or after selling it, the loss may be disallowed for federal tax purposes. 2. Roth conversion, moving from a traditional IRA to a Roth IRA. Roth conversions must generally be completed by December 31st to count for the current tax year. The amount converted is taxable as ordinary income in the year of conversion. Whether a conversion is appropriate depends on income levels, tax brackets, time horizon, and retirement goals. IRS rules apply. Example: your income is lower this year and you decide to convert $30,000 from a traditional IRA to a Roth IRA. All future investment growth on this amount is yours to keep tax-free, and qualified withdrawals in retirement will also be tax-free. 3. Maximize 2025 retirement account contribution limits. Make full use of your benefits. 401k 2025 employee contribution limit, $23,500, age 50 and above catch-up contribution, $7,500 to traditional IRA Roth IRA. 2025 contribution limit, $7,500, age 50 and above catch-up contribution, $1,000 total, $8,500. 3. Health Savings Account HSA, individual limit, $4,300, family limit, $8,550, age 55 and above can add $1,000. Available only with a qualified high-deductible health plan HDH. Example: if your federal tax rate is 24% and you contribute an extra $10,000 to a traditional 401k, you immediately save $2,400 in federal income tax. Retirement accounts are tax-advantaged savings vehicles with IRS-defined eligibility and limits. 4. Flexible spending accounts FSA, use it or lose it. Unlike HSA, FSA typically have limited rollover allowances. Many plans require unused balances to be spent by year-end, though some employers permit a small rollover amount up to $640 in 2025, if allowed, before the end of December. Make sure you check whether your medical FSA still has a balance. Confirm details with your employer's plan administrator. 5. Year-end charitable giving considerations. Charitable contributions made before year-end may be deductible if you itemize. There are 2 main ways to give. Method 1, cash donations. Method 2, donating appreciated stock. Donating appreciated securities to qualified charities or donor-advised funds may provide additional tax advantages, subject to IRS rules and AGI limits. Example: you bought a fund for $10,000 and now it has grown to $25,000. You donate $10,000 worth of shares to a charity. You receive a $10,000 charitable deduction, and the gain on those donated shares is completely tax-free. Your remaining investment stays in the market and continues to grow. This is one of the most common charitable strategies used by high-net-worth families. 6. Reviewing beneficiaries and estate documents. Year-end is when family changes are most common, making it an ideal time to review and update beneficiary designations for life insurance and annuities, beneficiary designations for 401k, IRA, and retirement accounts, wills and revocable living trusts, healthcare directives, and financial powers of attorney. Keeping these documents updated may help avoid costly errors or unintended distributions. 7. Portfolio rebalancing, aligning investments with risk goals. Market movements may shift a portfolio away from its intended asset allocation. Rebalancing helps realign investments with risk tolerance and long-term objectives. For example, if your target was 70% of stocks, 30% bonds, but due to a strong year in tech stocks, it has shifted to 80%, 20%. This means your risk level has increased, your portfolio volatility is higher. You are now exposed to more market risk than you originally planned. Rebalancing sells part of the assets that have grown too much and adds to those that are underweight. This is a key step professionals use to keep risk in line with the original plan. Diversification and asset allocation strategies do not guarantee profits or protect against losses. Summary: year-end 2025 is a golden window for improving financial efficiency. These 7 year-end considerations may help clients evaluate tax implications, strengthen retirement planning, support long-term financial goals. Most importantly, many opportunities are time-sensitive and must be completed by December 31st. If you have not yet established retirement accounts, opened an HSA or FSA, opened an investment account, developed a Roth conversion strategy, completed a comprehensive family financial plan, then year-end is also the best time for you to take actions. If you'd like me to provide a financial checkup and year-end considerations checklist tailored to your family, including tax, retirement, investments, cross-border planning, and insurance, feel free to reach out. Let's have an in-depth conversation. The key to smart financial planning is not complexity, but timing. The earlier you plan, the easier, more stable, and more in control your future will become. Thank you for following, and I'll see you next time.